tailored to your financial goals. So raise your hand or put your question in the chat and we'll make sure that it gets answered. So let's dive in. Jacob Young, welcome, and thank you for being here.
Yes, thank you for having me. I'm glad to be here in front of all of you again. Excited to share a couple insights, especially as the economy has changed and grown, especially with new administration. There's a lot to decipher. So I plan to go over that with you and tell you what you should be concerned about or not concerned about, as well as just the overall impact on what it would do to your investments and planning for your future, like retirement. So I want to make sure my screen is being shared properly. Is that okay? I feel like it's the side view. I guess that's okay. Just trying to show you the full screen.
Slideshow.
No screen, presenter mode. Well, we'll just do it the way that let's try this. Okay. All right. So we're ready to go here. Well, once again, thanks for having me back. It's good to be back. And we'll kind of start off by just looking at the overall picture, and then we'll get into a couple things that worry people: tariffs, interest rates, and what is the best investment if the stock market is overvalued. So we'll talk about all those things today. So here is the last several years. We're looking at about 50 years or so. And there's a lot of things that have gone wrong in the world, yet the stock market continues to grow. And every year, I'm sure we could put something bad that has happened. And you can see that it's had an impact, not just on some of the bigger things, but even smaller things. There's been economic impacts. Yet investments continue to grow. Long term is the best way to look at all of your investments. Retirement, you may say, well, I'm just a few years from retirement, and so I shouldn't be looking long term. But think of how long you're going to be in retirement. People are living longer and longer. This is not a retirement. The day that you retire, you need all of your money at one time. It's a long-term process. So we'll talk about how to balance preparing for retirement a little later. But just think long-term on the investments. Yes, they're going to go down at some point. In fact, that's the only guarantee that I'm going to give you, is that at some point in the future, they will drop in value. However, over time, they will grow. The economy grows. The stocks that back up the economy, as people buy new iPhones, go out to restaurants, take that vacation, buy that new car, as people have money to do that, the economy grows, companies make money. And then that moves on to the stock market. So it's normal to have a correction. In fact, we're going through a little bit of one right now. I'm not sure if we're officially at 5% or not. But if you look at this first column here, the stock market can be moving up, yet it's very common for the stock market to drop about 5% during a calendar year where it's moving upward. At the end of the year, it had a positive return, but you still lost 5% a couple times during that year. It takes about a month and a half for that to recover. And we actually went through one just last year. It's easy to forget because at the end of last year, the stock market was up. Yet we went through a 5% correction. The market from its peak to its bottom dropped 5%. People were worried, concerned, yet it came back again. Now, it's not often we see a 10% drop in a year where the market is growing, but that's also very common to happen about every 18 months or a year and a half. It takes a little bit longer for that to recover. And July of 2023, that was a positive year also. We saw a 10% drop, but by the end of the year, the stock market was up again. Now we get into some of the bigger ones here, and I'll just jump to 20% or more. That's less common, but it happens about once every 6 years. We just saw one in January of 2022. And it took a year for it to recover, about a year and a half to get back to where we were. And that was actually an average recovery time. I think it took a little over a year and a half. It typically takes about a year and a half. So it fit within the perfect normal recovery. But if we look at every 6 years, this is on average. We never know exactly when a market correction is going to happen. If I did, I wouldn't have to work anymore. And if you know it, then please tell me, I'll hire you as an analyst. Since nobody knows, on average, it lasts about 6 years. If we just went through one in 2022, 2023, 2024, we might have another 2 to 4 years of potential growth ahead of us, despite what happens in the world. And there's a lot of concerns. Some people have concerns about the administration. Some people are excited about it. There's global conflicts. There's interest rates that the current administration doesn't control. That has to do with whether people can buy a house or borrow money. And so there's all these concerns out there that are floating around. Inflation hasn't gone away, yet it's normal for a market to drop 5% or 10% when people are nervous or worried or something bad comes out. Yet over time, the market typically will grow for about 6 years. And I'm going to put 4 to 8 years as a range to think about. So the big thing that a lot of people are concerned about are tariffs. What will tariffs do? Now, tariffs, if I go back to my economics classes of college when I did international finance, it's always taught that tariffs are not good for a economy. It adds an extra tax, so it makes things more expensive. And then there's usually tariff wars that happen, so our goods and services aren't able to be shipped. Now, you could make the argument that we don't ship as much foreign, we import more, so technically this is beneficial. It will preserve jobs, and these are all accurate. And the jury's still out as to whether this will be a good thing, a bad thing, or just even a neutral thing. But the question that I get a lot is, well, is this going to impact my investments? Is this going to make the stock market go down? Is this going to make things more expensive so we have a recession? Now, here's just one example of many things that will be implemented if tariffs go through. And I think I can't even remember where we're at on whether they've been implemented or not. It kind of goes back and forth. But the average cost to make a car in China and ship it over here, you can see in the $55,000 range versus the United States in the $60,000 range. The cost with the tariffs will increase it, but has it gone up that much more that someone's going to say, well, now I'm not going to buy a new car because the $60,000 car or the $68,000 car is too expensive? I mean, those are highly priced cars if you're buying just an economy one, but that's the average cost. And when you look at that, it's not going to really deter the average person from going out and buying that car when they need one. And then that will apply amongst other goods and services as well. Whatever they're applying to that, it's going to raise cost, but does it deter people from buying that product or service? Or I think even there was an example of cans of soup. The steel that goes into that will make those costs rise, but does it really deter people? Is there still enough money in the economy, in people's jobs to pay for those things? And the answer appears to be yes. I mean, no one knows for sure, but it appears to be yes. So over the short term, when tariffs are announced, and that's this left-hand picture over here, if you can see my arrow, on this left-hand side, you see that there's a lot when tariffs are announced, it doesn't change the market too much. If anything, it has it go down a little bit. We lost about 4% in tariff round number one back in 2018. Emerging market countries went down a lot. Foreign countries went down a lot because now their goods and services to get over here are more expensive and maybe in less demand. But look at what happens after 3 years. So 3 years later, everything was up. Now, the US market benefited the most, and this is stocks in general. Are people buying more stuff and are companies making more money? This is not specifically to tariffs or not about tariffs. It's just, did everything grow? And the answer is yes. So even though there were tariffs put on previously, there was still growth in the stock market. And then let's not forget that we're in a global economy. And a lot of the products, if you walk down the grocery store aisle, and I'd like to use the soaps and shampoos as you walk down, there's probably about half of those products are foreign products that you would have think are US products. I like to think of Suave and Dove products. Those are foreign products, Unilever. And then the other half of those are US products. Think of anything done by Procter and Gamble, like Dial soap and Tide detergent. So you're buying foreign products every day. You're buying US products every day. And if you go on a European vacation or a Latin American vacation, you're going to see the same types of products in those countries, all run by probably 3 or 4 different companies. So here's a slide that just explains, and I don't want to go too deep into tariffs, but here's a slide that just shows as tariffs get implemented, it does increase revenue for the government, and it doesn't necessarily impact the purchasing power. People are still buying things that have tariffs attached. So the revenue goes up for the country, for the government, and the revenue is going up because people are still buying that. So it doesn't necessarily create a recession just because tariffs are implemented. And the question is, can the economy absorb higher costs? And the answer appears to be yes. I do want to pause right there and remind everyone to submit questions. And if there are any questions that have come in, I'm happy to answer them now. Otherwise, we will move on to the next part of the presentation, but please submit questions as they come in, and we'll pause a couple more times for that. So if we talk about, can the economy absorb higher costs, and this could apply to everything, not just the tariffs that I covered, but as inflation is increasing, or hasn't gone away, I guess is probably the best term to use for that. The question is, can our economy become more productive, more effective than what is projected? And so if we look back in time when PCs, computers came out, the projection was that there would be about 225 million new PCs purchased, and that number was actually more than projected. And so basically, computer companies made money, but it made people more productive. People were buying computers, companies were buying computers because it made them more productive. The things that those computers could do that the old computers couldn't do made them more productive. And then we can go along the lines here with internet users. It was expected, how many people would want a high-speed internet connection versus the old dial-up. And that number went way above what most people were expecting. And then smartphones became more productive. In fact, I just finished a trip in Nicaragua. People don't have a lot of money there, but everyone has a cell phone. Everyone does everything through their smartphones. It's a global necessity almost in these days. They may not have the electricity to plug in, but they do have a smartphone, and they find places to plug it in and get the connection that everyone needs nowadays. And then the cloud servers have been productive, so you don't have to store all your data on a computer. You don't have to remember what your passcode was for that hard drive, that external hard drive that you had. Everything's stored in a cloud now, and that makes businesses more productive. Maybe even you've used those as well. So now the question is, what will AI do? And we're expecting a lot of increase on the software side of things, as well as it's going to create to create AI, you need power. and there's not enough power to run all the AI that's expected and projected that we're going to be using. You need server buildings or data centers, I guess they're called, and you need the servers. So there's infrastructure that has to be built to make all of this expected and demand for AI, which could be more than what's expected. Here's the projected trend: 1.8 trillion people will be using AI, and then that number may be higher, which makes us all more productive. So can our economy be more productive and grow despite all the negative things that are out there? Now, here's one, and I hope I don't spend too much time on this because this can get deep, and I don't want to put anyone to sleep. But I'm going to do my best to explain it without putting you to sleep and apply it to your own personal financial well-being. So, as interest rates increase, it becomes more expensive to borrow. So, for 20 years before 2022, interest rates were at all-time lows and stayed at that. So it was easy to borrow, easy to buy a house, easy to borrow money if you wanted to start a business. It was inexpensive, but inflation started to creep up, and it made the Federal Reserve wanted to make it more difficult to borrow money from your home, borrow money on a credit card, borrow money in any sort of business sense, in order to, and then also encourage people to save more and not spend as much. So they raise the interest rates so that money is not moving as freely. And by doing that, it's supposed to reduce inflation, but it does mean that you have an economy that's not growing as much. Now, here is the balance the Federal Reserve's trying to do: is they want the economy to grow, but they don't want it to grow too fast. Otherwise, there's a lot of money chasing very few goods and services. There's only so much that we can produce and sell, so it creates inflation. So it's expected that the Federal Reserve will lower interest rates to a lower rate, but not much lower than where it's at today. Now, this is actually good news in a sense, in that if the Federal Reserve is saying we want to lower rates because we feel that inflation has been tame, but we also feel that the economy is really strong, so we don't want to lower them too much because then it becomes too strong and inflation comes back again. So the fact that the Federal Reserve is projected to lower interest rates only slightly is technically a good sign for the economy. Now, it does make it more difficult to buy a house. It does, people who are investing in CDs get a better rate. So that part is good. It does make it a little more difficult to expand your business because the borrowing is more expensive. Yet the Federal Reserve feels that the economy is growing fast enough where they don't have to necessarily accelerate the economy, bring down borrowing rates so much that it encourages people to spend, encourages people to take money out of their house and remodel or build. So this is kind of a positive thing on the stock market. Now, remember, don't forget that long-term chart that I showed you at the beginning. We'll come back to that. That long-term chart shows that over time, just being invested is the best thing. So whether I'm wrong and the economy is due for a correction and a crash, the stock market, over time, it's going to be okay. So rate cuts usually boost the stock market and at a place where we can actually, the Federal Reserve should be able to reduce rates without necessarily doing it because there's a recession. They usually, if times are bad, they lower rates to where it's really cheap to borrow to get the economy going. So we're at a good place. The stock market has averaged almost a 28% return, almost a 30% return when the Federal Reserve can cut rates slightly, but not because of a recession. Now, if there is a recession coming and they have to cut rates, there's still necessarily, it helps the economy, but it doesn't necessarily mean a positive growth. So I think we're at a good place when we look at the Federal Reserve not wanting to cut rates too much. Now, if you're looking for good actually, I do want to pause right here, see if any more questions have come in. Do we have any? No. Okay, so I've put everyone to sleep. Well, that's okay. I do that. That's my job is not exciting. I love it. I get excited about this stuff. And I will talk at the very end that we want all of you to come in and review your investments with us, your retirement plans, your other goals, whether you're saving for a house, college, whether you are concerned about your life insurance protection. These are all presentations we've done. And we see some of you come in for a meeting, but we hope to see all of you or most of you come in, even if you haven't saved much, just how to get started and what's the best strategies for you. Well, let me give you one idea that you may be able to apply to your own personal investments, either through the 401k or something else. So this dotted line here, the red dotted line, is a measurement of whether large company stocks compared to small company stocks are overvalued or undervalued. So when we talk overvalued stocks, think of NVIDIA. And that is a stock that has grown immensely over the years. And the reason is because they need those high-powered chips to run the AI servers to make those work fast enough. It has to do a massive amount of computing. So NVIDIA has grown a lot because their chips are in demand, and we're expecting that demand to continue for foreseeable future. However, then there was an announcement that someone was able to do the same type of computing with less expensive chips at the same rate that they needed to. And by doing that, NVIDIA in one day lost 25% of its value because it was feared that, okay, well, they don't need those expensive chips anymore. Now, the point is that some stocks can get overvalued. Now, NVIDIA may still have the same value. I don't know. We don't know if it's overvalued or not, but the amount of earnings the larger companies are having versus how much money the companies are, how much they're earning now versus what they expect to earn, there's an overvalued or undervalued rating, meaning there's a lot more growth potential in something that's undervalued because if they just do normal business, they should get back up to their real value. So to explain what this chart means, if I try to simplify it, basically it's showing that small and medium-sized companies are undervalued. So if you were to add a fund to your 401k plan and do something different than the standard target date, I would encourage you to add a small or mid-size fund to your portfolio and just put money in on a monthly basis. Don't expect it to grow tomorrow. Don't expect that unless you're that person that can predict the market. Please let me know. But the stock market over time tends to balance out. And it's possible that the large stocks that have overgrown might grow less, and the smaller companies might catch up to those. So that's an area of undervalue that you can consider. And then your technology still has a lot of growth potential, whether it's one stock like NVIDIA or all the stocks, software, technology, semiconductors, those are all areas of growth potential as well. And then if you were to want to be in something conservative, but play a role in the potential of AI, I would invest in something like utility stocks. I don't know if you have that in your 401k plan, utility mutual fund, but what you probably have is it's called large value, and they invest in the more conservative type companies that the value of them that tends not to get overvalued. Think of your banks, think of your soaps and shampoos and food companies, but also think of electric companies. They're not going to double their business overnight, but they're going to steadily grow, and they don't tend to get overvalued like some of the individual stocks that can be. So my recommendation is small company, something that's called large value, or specifically if you have a utilities fund, that's a good idea. And then large growth or specifically technology. And then I think there's still a lot of room for it to grow, even though some stocks, just some, are overvalued. So let's go back to this big picture. And actually, before I do that, any more questions, or are we Okay. Well, let's put this into perspective for your own personal retirement. Think long term. And just if you have 5 years left, don't think short term because you're going to be retired for the long term. So look at some of these bigger drops. If you have 5 years or more before retirement, it's okay for there to be a large drop because you're going to buy shares at these lower prices. And yes, it took about 5 years to get back after the global crisis, and that was one of the worst corrections. If you continued to buy during all of these times and didn't pay attention to the value of your account, but what was going into it, all of these prices actually appreciated a lot. So you actually grew money even at a time when the stock market was declining because it declined and grew again. Now, for those of you saying, well, I'm going to retire within 5 years, we want to make sure that there's some money set aside for low risk investments. And you can do that technically. The target date funds that most people use will do that automatically. They'll reduce the amount of stocks to bonds. But I almost feel like you're better off having your own a little bit in a bond fund that kind of covers 5 years worth. And the reason is because in the target date funds, everything's mushed together. And if it's all mushed together, you're selling, if you take money out of the target date fund, you're taking out stocks along with bonds together. And my preference would be for you to have about 5 years worth of what you think you'll need in 5 years in separate and in a lower risk, whether it's a money market or a bond fund. We can talk about those differences if you come to see us. But choosing one of those funds where you've put about 5 years worth of your income. And so if we do go through this crisis, and if we've already started that another financial crisis unexpectedly, and that's going to happen. I doubt that's the case, but if that happens, you have 5 years worth put aside so that you don't have to change your retirement plans. You can still have income, and then you're just waiting for the stock market to recover. You still want stocks because once they do recover, you can see they tend to go on a run of, in our estimate, somewhere between 4 to 8 years. Well, that's everything I wanted to talk about today. I hope it's giving you confidence to invest and not any fears. I hope I dispelled some of the fears that you might have. Encourage you to put in what you're putting in, getting at least the 100% of the match that you can from Graniterock. They're very generous with their 401k plan. And I'm going to encourage everyone to come see us. This is our financial planning snapshot. This is provided for you by Graniterock, and so you do not have to pay anything for this service. We'll look at your current situation. We'll review how you're currently invested, if you're on track for retirement, if there's another goal that you might have, and then there's a few other things that we've talked about in these meetings, such as education planning, life insurance, even long-term care, how to get the most out of Social Security, if you have some outside real estate investments and how they combine with your retirement plan. These are all things that we can merge and blend. And if your situation's complex, we do have a more detailed list of services that we can provide for you. And you still get the Graniterock discount, and these have some extra fees, but majority of the people that we see are able to just fit within this financial planning snapshot. And so we would like to encourage you all to come see us. We do have a new office that many of you have seen us at our old office. Our new office is at 17 Aspen Way. So we're not closer to the Graniterock main site, but we are still just as close. And we do have a new email. Kim Strong is the one. Before you've emailed Tina to set up an appointment, kim.strong at Jacob Young Financial, or you can reach out to your Graniterock team and they can pass that on to us. Well, were there any other questions that came up in this? Okay.
Question in the chat says, curious if you are a fee-based financial planner.
Yeah, so that's a good question. We do most of our business fee-based. We think it's the best way for both investor and for us. It puts us on the same side of the table. It it helps your money to grow. And if I were to very briefly explain what fee-based is, we charge a percentage of the investments as opposed to a upfront commission to pay us to sell you something. Now, we still work with commissions and other investments where it's the right fit. It's a very small part of our business, but occasionally, if you're a person who buys something and just wants, doesn't want to make adjustments, especially on low risk investments that don't need as many adjustments, there are times where it's beneficial to you to just pay a one-time fee and kind of let it grow steadily. So we do both, but fee-based is a majority of what we do. And we're always looking after the best interests of our clients. I'm a certified financial planner, so I'm required to do that. And so we do have other ways of getting paid if it's the right fit for you. But if you come in just for the financial planning snapshot where we give you some direction and some planning for you, that's provided by Graniterock. That was a good question, though. Thank you.
Jacob, how about tell us a little bit about what we can expect if we make an appointment with you for that financial snapshot? What do we need to bring? What do we expect during that meeting? Do we need to bring bank statements and brokerage account statements, credit card statements? What do you look at?
Well, that's a very good question. I'm glad you asked that, Shanna. And so if you look on this chart here, the first thing we're going to do is find out about your financial picture. So to do that, we need to know what you have in investments. Now, we don't have to look at your bank account unless there's a lot of money that's just built up there that isn't used. We do want to make that as we want that to be a valued part of your financial plan. But if it's just a revolving amount and you keep a cushion in there, and whatever you do consider a cushion that you would never invest, that this is for emergencies, we don't need to see that. But we do want to see your 401k statement, outside investments, whether you've done other retirement plans with other employers or on your own. We do want to see if you've built up a good amount of savings somewhere. So we'll ask you to send us those statements. It's helpful to see your taxes, and that way we can kind of coach you on how much you should be saving pre-tax versus maybe through a Roth contribution where it's you don't get the tax break, but maybe you don't need it. So taxes are helpful. And so we'll review your holdings, your investments based on your needs and goals, and then we'll project how much you should be saving in order to reach those goals. And so that's another place where the taxes come in, and a budget, if you know how much you're spending. Now, I'm not a fan of budgeting. I think we've talked about this before. If you recall some of the other ones, it's hard. There's so many moving pieces to a budget, so that we have some very easy ways to create a budget for you. But to come in and say, these are my expenses, I would say probably 6 times people have been accurate about that. They either over project how much they spend or under. They're never exactly right. And it's hard to. I don't think I could be exactly right because there's always things that come up. And if I overestimate, then those are things that aren't real either. So we help you kind of create that budget about how much you can save and how much you should be saving for retirement. And then whatever other goals you have. So if you do have outside life insurance, we're going to look at that to make sure there's enough there. If you save money for kids' college or what their college costs will be, we want to help you with that. So Social Security, we do want you to bring in a Social Security statement if you're about 5 years into retirement. But we give you the list, and it's very simple. I think sometimes people are nervous coming in thinking, oh, they're going to, my financial situation isn't as good. We see all different kinds, and our job is to help you get on the right path, not to find what you haven't done right, but to compliment you on what you have done right, and then try to get you on the right path with the other things that need improvement. Does that answer your question? Anything else on that?
There was you guys can hear me. There's another question. If we schedule an appointment, do you provide a checklist of what you would like us to provide ahead of time?
Yeah, so through an email. So when you set up an appointment, we send you an email of a list of things to bring, what we'll be talking about. And at that, we can usually do everything in one meeting. If you bring everything in, sometimes we need a follow-up meeting.
The beyond the initial valuation meeting? I know you mentioned that Graniterock has a discount service for that.
Yeah, so if I jump to this next one, and the question is, what about the additional services that we offer? So these are people who have a lot of moving parts to their financial life. Maybe they have, or if you're approaching retirement and we're trying to create what we call not just do you have enough money, but how do we get the money to you? So this retirement future income distribution plan, this is something that has a little more impact because it's one thing to say, yes, you have enough, you can retire comfortably, but how do we get it out to you with these other moving parts, such as tax efficiency? So we look at your taxes in the simple plan. We give you some coaching on that, on what to be saving, how to be saving. Here we actually do an in-depth tax efficiency review to see how can we save you your taxes both now and in the future. And then we do a much more thorough dive into your investment allocation. We do some various reports on that. I would say a majority of people fall into the snapshot category. And so we don't go to this one that often, but when we do see it's a right fit, we'll let you know. And we can do a majority, even a complex, we can do the snapshot analysis, and it may not give you everything you need to know, but it'll give you enough. But if you look at all of these different services that get included, if you have an estate that needs some planning around that, how to get assets from one generation to the next, a little more detailed on your Social Security planning, how to get the most out of that if you're right at retirement store. So there are additional services where you get a discount, and we can tell you what the cost of all of that is. Now, for those who put assets with us, if you invest assets, then it's either no cost or there's a much steeper discount on that.
There's another question. Do you have advice for other revenue streams?
Of how to get other revenue streams? Well, I'm not going to coach you on something that's out of my wheelhouse. I am a business owner and have coached many of our business owning clients on ways or the right way to go about setting up a business. If you have other revenue streams, how to save taxes and invest that money. I'm not sure exactly what that means, but we do, if it's part of your financial plan, we do help you with that. And the only thing we're not good at is, how do I make more money? Well, we can talk about it, but we'll leave that to you and your own knowledge. Yes. All right. Well, these are all great questions. I appreciate.
So, what is the percent charge for investment and/or transactions, or does the percentage fee vary?
Okay, so that's a really good question. So if you were to put money with us and assets with us, our fees, we've priced ours not necessarily below everyone else to be below everyone else, but we started off saying, "Oh, wait, what do we need to charge in order to be compensated for our detailed analysis and planning that we do, not just one time when you first come in the door, but it's on an ongoing basis, even throughout the year as your financial situation is either adjusting, changing, or taxes change all the time." So we start off at a lower fee than what most of our competitors are. And so it starts off at 1.25, but at our highest level, we're only charging 0.5%. And so I recently brought over a colleague from, and I hope I'm not, he came from a different broker dealer. I don't want to mention any names in case that gets me in trouble. But he came from a big, we call them wirehouses, and their minimum charge is 1.5%, and then they get as low as 1% at some point in the future. And so we've looked at that. We don't have to charge what they're charging, even though I think we do even more on the planning side. We just tried to see what do we need to charge in order to be fairly compensated. Now, part of that comes that we don't have a parent company. We're independent. So there's no parent company saying, you need to earn money for you and for us. So because we don't have to share that that's another reason we can charge less. But as far as planning, when you work with the big wirehouses, they're investment focused and they're great advisors there. And I encourage you to use them if you have a good relationship with them, but they're not planning focused. And so we look at the planning first, the big picture, and then cater the investments to that plan. So it just explains why we're different. And I don't want this to be a commercial just about us. We're here to support you and the generosity that Graniterock is offering and at least getting you started on this financial planning snapshot. But and you can also set an appointment with us, the consultation, one, you get the planning, but to ask about our fees and other things, we can also talk to you about that individually too. So I'll just finish here back again with Kim's email address or our phone number for the office. So you're welcome to call or send an email and we can set you up with a meeting to go over your snapshot, your current financial situation. Well, thank you, everyone. I appreciate being in front of you. And I know I didn't put some people to sleep, so that's good. And we look forward to seeing each and every one of you, whoever would like to just see what their situation is like and what they need to do a little differently now to make adjustments to be on track. We really want to help you. We want everyone to have that benefit. So we look forward to seeing all of you at some point in the future. Thank you.
Thank you, Jacob. Thanks everyone for taking the time to be here today. And if you have any questions, feel free to email me and I'll make sure they get to Jacob as well.
Thank you.